Hello everyone, what many people are wondering right now is just when this enormous asset bubble we are currently in will pop, or what the timeline for that is. And this is a very difficult question for anyone to answer because predicting in advance what these sort of events could be like is nearly impossible. However, this doesn't mean you cannot recognize when the market has almost peaked and the bubble has just started to pop. Today I will look back at what Jeremy Grantham has said in past interviews and past letters he has written regarding past bubbles in order to give you some of the commonalities between them that he sees as to what the warning signs they give before a collapse, as well as what common events took place after the crash began. Now right away, a big disclaimer to make is this will by in no means give you the ability to know exactly what day the current bubble will have popped, but this will hopefully give you an idea of what to keep an eye out for, because as we know from William Shakespeare, the past is merely prologue, meaning history does in fact repeat itself, albeit in different forms than previous times, but history does repeat itself nevertheless. So first off, we'll cover commonalities Jeremy has identified past bubbles have shown just prior to collapsing, and most of these past characteristics are not hard to find today, which indicates that we are probably relatively close to when the collapse will occur. Immediately prior to collapse, these past notable bubbles, such as the dot-com bubble, the crash of 1929, which led to the Great Depression, and the crash of 1969, which is often called the forgotten bear market because kind of like the 2020 crash, the market crashed but managed to recover very quickly than previous market crashes. So all that being stated, here is the most relevant characteristics to keep an eye out for prior to when a bubble crashes. Number one is rampant speculation. Just prior to all of these major market crashes, nearly everyone was in the stock market who could be, and the people who had never invested before often jumped in months or years prior to when the crash did occur. We've seen this most recently with all of the hype in the last months of the dot-com bubble, and this is eerily similar to all of the zero commission trading and trading apps that are going on right now. You know, millions of people jumping into investing who have not before, who are using their stimulus money or who are just laid off or who can't gamble and they're simply going to the stock market as an alternative. Or they've been convinced by their friends or all the fake gurus out there that it's a great way to make a quick few bucks on the side. So I can see a lot of rampant speculation right now. I think most of you would probably agree with that. Number two is an extremely bullish sentiment. Immediately prior to all of these major crashes, sentiment both in the Wall Street media and in the eyes of all of these novice investors was extremely bullish, and it was always a mindless bullishness, meaning that there was no real reasons for this optimism except for the crowd thinking, really building on itself and just the emotion getting behind it. And this is probably the area I would say that there still needs to be some building in before I would call a market top. There is still some smart money sitting out on the sidelines right now, and there are just a lot of people out there saying that a market crash is imminent. So as a contrarian, this almost leads me to believe that the crash isn't going to occur just yet, but it will likely be when nearly all of these bystanders have jumped into the market and they've really dismissed a lot of these concerns that they've been having, and you just don't see near as many of these market crash 2021 news articles anymore. If anything, once that occurs, I become much more cautious, because at that point nobody else can get into the market to continue boosting it, to all these, keeping up all of these overvalued asset prices. That would just basically mean the end of that ability for the bubble to continue in that way. Number three is the reality of valuations and fundamentals have always been put off as some old way of thinking. We've seen this, immediately before the crash of 1929, actually about 90 years ago, which led to the Great Depression. In that, at that time, people claimed that they had reached, a quote-unquote new plateau of perpetual wealth, or that the market would keep going up forever, and that the old ways of thinking and valuing assets had been proven wrong. So the market had permanently shifted to this new state, and Jeremy Grantham points this out in his most recent article of Waiting for the Last Dance, that in the end, every time this perceived shift in paradigm takes place, it was proven wrong. So it was really unlikely that anything is different this time. In value investing, as it is commonly called, or at least caring more about fundamentals, will likely once again become much more relevant after this market crash. Number 4 is speculation in risky assets becoming a mainstream. And I'm sure we can all think of good examples of this fourth characteristic. This is just so pervasive right now. Whether it be junk cryptocurrencies being boosted to billion-dollar market caps, or day traders, boosting the price of bankrupt stocks such as Hertz, a classic example, or with GameStop just being boosted in that meteoric rise that it just had, or people jumping into SPACs, which have been around for a while but have exploded in popularity recently. This is one of the most relevant areas I see right now. People have gone, for lack of a better word, insane. There is absolutely no fundamental analysis done in any of these examples, and the only real reason why the prices of these tokens, and I call them tokens because they are likely worth very little, if anything, is because there is apparently an immensely great supply of foolish people out there right now who will buy these tokens for a higher price than the initial foolish person bought them. And of course we know how this ends. Eventually nobody is willing to bid the price up anymore, and everybody wants to cash out, and the price collapses. Charlie Munger called out SPACs as rampant speculation in a recent interview, and just another sign that this is in fact a major bubble that is currently underway.
Well, I don't participate at all, and I think the world would be better off without them. I think this kind of crazy speculation in enterprises not even found or picked out yet is a sign of an irritating bubble.
So I've gone through the 4 major characteristics of what has happened immediately prior to these immense past market crashes, and now I'll get on to what Jeremy and others have pointed out regarding immediately after these bubbles have begun to crash and after they've topped. So in the first several months of the bear market, looking at past examples, we can find several commonalities between almost all of the large crashes that have occurred, and those you'll hopefully begin to see many of these characteristics are beginning to pop up right now as well. The first characteristic I'll list is several months before the major market indices began crashing in the dot-com crash, several smaller speculative stocks began going under, and these had been some of the hottest trending stocks up until that point in time. Also, a great example from the Great Recession in 2008 can be found in Bear Stearns, which had stock price collapse and really bad rumors and news come out about their management in early 2008, and that was roughly 6 months before the broader markets tanked in late 2008 due to relatively similar reasons as what tanked Bear Stearns stock. We've seen some of this recently with some of the most trending SPACs, such as QuantumScape, which is ironically a SPAC that Jeremy Grantham himself is involved with, and the company has outright stated several months ago that they will be in the development phase of new battery technology for another 4 years, so they won't have any revenue or any earnings for at least another 4 years, and yet it was and is still boosted to massive valuations, but QuantumScape has fallen significantly in value from its high point. As well as I would cite the pullback in Tesla stock that has been one of the most trending stocks in the last year, but we haven't seen a ton of this yet, so this would be something to continue waiting for, in my opinion. Now, continually this has caused some concern and worry among investors, and in the past, looking back at the response from the market, it has always overlooked these early signs that things aren't going well, and sadly this continues to go on. As Warren Buffett has said, euphoria is your enemy and fear and caution is your friend when it comes to investing. And in the late stages of bubbles like this, most investors tend to be overcome by euphoria. And the last thing, very commonality I'll be pointing out here is there will be short blips of market uncertainty and panic selling before exuberance and euphoria overcome any potential doubt. For example, during all these past crashes, so the 1929 crash, the 2000 crash, and the 2008 crash, there were brief periods of panic before the market resumed its march to new all-time highs before the final crash actually happened. So I found a good Wikipedia article on the 1929 crash, and just this really describes kind of what has been going on in the current market for the last year. Despite the inherent risk of speculation, it was widely believed that the stock market would continue to rise forever. On March 25, 1929, after the Federal Reserve warned of excessive speculation, a small crash occurred as investors started to sell stocks at a rapid pace, exposing the market's shaky foundation. 2 days later, banker Charles E. Mitchell announced that his company, the National City Bank, would provide $25 million in credit to stop the market slide. Mitchell's move brought a temporary halt to the financial crisis, and call money declined from 20 to 8%. However, the American economy showed ominous signs of trouble. Steel production declined, construction was sluggish, automobile sales were down, and consumers were building up high debts because of easy credit. So similarly to this time, the market, was bailed out. At this time, it was an individual who was able to do it, not the Federal Reserve, and it only took millions back then and not trillions this time. So that just itself shows the magnitude of this current bubble that we're in, compared with a truly historic past bubble. Even though the dollar has lost the majority of its purchasing power since then, it really shows the magnitude of the current crisis that we're going to be facing when this does finally crash. Also, similarly to this time, we can see that the real economy of the United States and most countries are extremely beaten down. Many businesses are barely getting by, and supply chains are still in shock or complete shutdown from the extreme supply chain shock that occurred early of last year. So this video hopefully has helped you to identify the cyclical nature of markets, and especially what characteristics to keep an eye out for. And as to what you do regarding this information is completely up to you, as everyone has different levels of risk they can take. But one thing for certain, according to, I would say, most of the great investors of our time, is that this is a massive bubble that won't end well for those who are caught in it when it finally does pop. So I hope you guys enjoyed this video. If you want to hear more, just consider subscribing, and I hope to see you again.